Today we're going to take a look at the ETF fund that was awarded the best new active ETF of 2025. Did it deserve this honor? We're going to find out right now. That ETF we're going to talk about today has had a 15.5% average return since inception, and that was in January of 2024. It's outperforming peers like JEPQ, which had a 12% average return since that time period. If you like passive income, you're going to love this channel, so make sure you subscribe to it. And please drop a like on this video. Please hit the like button. I'd greatly appreciate it. The ETF I am talking about is the QQQI, which is an NEOS ETF, and this was the award winner for 2025 for Best New Active ETF. It does have a monthly distribution. The expense ratio is a little lower than some of the other monthly distributors at 0.68%, and the distribution rate has been over 15% APR at 15.35%. First, I'm going to go over the details of this ETF. Then I am going to show you how long it would take for you to double your investment on this investing in this ETF. So make sure you stick around. Okay, what are the benefits of the QQQI strategy? Well, the fund seeks to distribute high monthly income generated from investing in the constituents of the Nasdaq 100 index and implementing a data-driven call option strategy. It's actively managed by NEOS. The fund seeks to take advantage of tax loss harvesting opportunities in addition to utilizing NDX index options classified as Section 1256 contracts. The fund utilizes a call option strategy that may include both sold and purchased NDX index options, which may provide the opportunity for upside capture in rising equity markets. Okay, so what is this ETF holding? Well, the securities listed here are 8.65% NVIDIA, 8.61% Microsoft, 7.49% Apple, to list a few others: Amazon, Meta, Broadcom, Netflix, Tesla, Costco, and Alphabet, which is Google. If you want to earn up to 60 free stocks, make sure you use my link in the description of this video for Moomoo. All you have to do is sign up and make a deposit, and you can earn up to 60 free stocks. How much are those juicy distributions? Well, so far for 2025, January had a 62-cent distribution, February 61, 58 in March, 53 in April, and the last one was 63 cents per share in May. Okay, so what is this ETF holding? Well, the securities listed here are 8.65% NVIDIA, 8.61% Microsoft, 7.49% Apple, to list a few others: Amazon, Meta, Broadcom, Netflix, Tesla, Costco, and Alphabet, which is Google. It's paying out a pretty high dividend. How does the price look? Well, let's take a look here. The price so far has taken a dip with the rest of the market, and it's almost back to where it was back in March. The high got to $54.45. It's currently at $50.95. So it's back above some support here. If it gets back over 52, I think it can go back to all-time highs. Okay, I wanted to show you something pretty cool. I overlaid the charts. The pink is the regular QQQ Nasdaq, and the green and red candles is the QQQI ETF. They are very closely correlated. If you see, they almost match identical to each other. So getting that APR, that over 15% APR. Long term, it could possibly keep up with QQQQ, or actually maybe even outperform the QQQ at times. That is definitely possible, and you're getting that 15% APR income. Okay, let's quickly go over the key points of this ETF, and then I want to show you how long it would take to double your investment. So the ETF was launched January 30th of 2024. The dividend yield is 14.93%. That's a trailing 12-month as of June 10th of 2025. The expense ratio is 0.68%. The strengths of this ETF are the high monthly income, 14 to 15% yield, tax efficient via options and tax loss harvesting, strong NAV growth and downside protection from covered calls, and it has been outperforming the Nasdaq 100 and similar ETFs. The risks of it are that it caps upside in bull markets due to the covered calls. It's got high volatility from the Nasdaq 100 exposure. Well, if you're getting into this, then you want exposure to the Nasdaq 100. That's a given. 99% of the distributions are return of capital, reducing cost basis. And it's had a short track record so far, about 1.5 years. Who's this for? Income-focused investors seeking highly yield and tax efficiency, comfortable with moderate risk and limited upside. Okay, to double your investment, if you take $10,000, your net return would be 14.82%. That's 15.5% APR minus the 0.6% and or 0.68% in fees. If we were to reinvest the dividends monthly and we have a stable yield and price, the calculation would go as follows. Using compound growth, it would take 4.7 to 4.9 years to double the price, and that's based on a 14.82% return. The caveats of this are market volatility and yield fluctuations may impact the results, obviously. Return of capital affects cost basis, and the short history limits long-term certainty. So I do like the QQQI. I think it could be a small part of my portfolio going forward in the future. Please leave in the comments which ETFs you like and which ones you would like for me to cover in the future. As always, thank you for watching and have a great day.